book that I would feel like I should be writing at this time. And it wouldn't be particularly enjoyable, but I think it would be the right book.
I mean, I think one book that will definitely be written will be a book about the vaccine developers, because they are right now the most important people in the world. There's no question. The faster they can get a vaccine developed, the better off we'll all be. When people talk about the Fed, the Congress, the president trying to deal with the effects of the recession, well, that's what we're doing just to tread water while we wait for somebody to save us.
Right.
So
yeah, maybe John Carreyrou should write follow up on To Bad Blood about the vaccinators.
The vaccinators, sure.
The vaccinators. I agree. That is fascinating. It's well beyond my area of expertise.
Sure. Yeah.
I mean, right? Don't we sort of feel as journalists we could cover anything if we're given the space and the time and the resources to do it? So I feel like I could get my mind around it.
Sure.
But obviously there are people who are more qualified than I.
Well, there are also some people who have a big head start, who are deep into this. When you cover a story day to day, and you develop all the sources, and you're really close to it, people come to you with, say, would you like to do a book out of this? And it's an easy transition. I mean, it's not easy to write the thing, but it's easy to say yes to the agent or the publisher.
Yeah, very easy to get, or easier to get a book contract. I won't say it's very easy. Easier to get a book contract if you've been covering a subject and you're a working journalist. But actually writing the book, that's where the real rubber meets the road. A lot easier to get the contract than to write the book.
You're speaking from experience there.
Absolutely.
Can actually you talk about that a little bit? Once you have gotten somebody to buy into your concept of a book, do you have this sense of like, oops, what did I just get myself into?
Yes, that's one of the emotions. Each book I've, even though I'm not qualified, I'm a little bit qualified, but not fully qualified to make this comparison and this metaphor, it's a little like childbirth. I mean, I was there at the conception and I was there at the actual birth, but I didn't actually, experience the 10 months in between. But it's a little like, it's incredibly painful along the way. It's sort of like climbing Mount Everest, very painful. It's a great thing to have done, like climbing Mount Everest if you survive, or like childbirth if you survive, and having children. And then, you have this child which you love and lavish love and attention on. Same with a book, you love it and you're proud of it and you want it to sell. And of course, it hurts when it doesn't sell, and it hurts when you get a bad review and all of those things. But if you actually remembered what it took to write that book, like I finished books and I can't even remember actually doing it, writing them. I just like, how did that even happen? Because, you do a little bit every day. And so next thing you know, after 2 or 3 years, you're done. And then you look back and say, I don't even remember writing it. But if you did remember writing it, like if you did remember the pain of childbirth, there's probably no way you'd ever do it again.
Yeah.
If you remembered, what it was like to climb up Mount Everest, you probably wouldn't do it again. Most people, of course, don't if they survive. But childbirth, people somehow forget the pain of it. And then they're back doing it again.
Right.
A lot of the times. And that's the way it is with books.
Yeah.
I mean, it's very exciting to get a book contract, especially for me, having been a former banker, to get a book contract from a real publisher, and then do a book, like The History of Lazard, which of course was extremely exciting to me having worked there, that I could actually let people in on this story of this crazy firm. That was extremely thrilling. So every day was kind of like a joy to work on it. But it still was painful. But once it was done, it's great.
Yeah, yeah. So what have you written, you've done any pieces specifically related to the economy and COVID-19 in the last few months?
Yeah, I mean, I've done a lot of pieces, both for the New York Times op-ed page and the Hive on Vanity Fair, which I write for at least once or twice a week. Yeah, I've done a lot of pieces. Everything from what the Fed has done by injecting $6 trillion worth of liquidity into the system, and how that is allowed the capital markets to rebound in a tremendous way. I mean, one of my favorite things, Peter, I don't know if this is just unique to me, of course, is I love looking at the St. Louis Fed charts on the high yield average trading of high yield bonds. And what you can see is that the yield on the high yield bonds was completely mispriced at 5% for months and months, years and years, ridiculous yield of 5%. And then in March of this year, you can watch that yield like literally skyrocket 650 basis points in a week or two, so that it was yielding 11.5%. And then you see the Fed step in on March 23rd, and then again on April 7th. And I haven't looked lately, but the yield was more like 7%. So we had this incredible round trip of people of fear and greed coming together, and the yield on the high yield bond average yield skyrocketing. People, I've been railing against quantitative easing and this people mispricing risk, and how can a high yield bond, which should yield 11-12%, yield 5%? It means people are taking all kinds of risks that they're not getting compensated for, which means they're overpaying for those bonds all the time. And that just was making me crazy, because that meant that a huge bubble was building in the corporate bond market, which of course is now we've seen to come home to roost. So I was actually very excited about the yields on the bonds getting up to 11.5% or more, because that's where they should be. And then the Fed steps in, does its thing, which of course it had to do, and then the yield is down to back around 7% again, which once again people are going crazy buying bonds and not getting compensated properly for the risks they're taking, which is a thing that just makes me nuts about the way our capital markets are functioning in the last 13 years. And I think we really need to ask ourselves what kind of economy we've created here. Do we have a free market system, or do we have a quasi-socialist system? I'm thinking it's more like a quasi-socialist system, and I'm also amused myself by the fact that both times this has happened in the last 12 years, 13 years, it's been during a Republican administration, which are supposed to be the free marketers, both of which are loading on the national debt, loading on the intervention, having the the central bank going in and buying all sorts of debt securities, now even potentially buying high yield ETFs. People are even
what happened?
equity. I mean, what is going on here? So so the answer is I've written a lot about this, and I have a lot of opinions about it too.
But Bill, on the one hand, I can see what you're saying. You're creating moral hazard. You're bailing people out who should bear the consequences of their mistakes. On the other hand, if the Fed doesn't come in, if Congress doesn't give a bailout, then things are worse, right?
Well, by definition, of course. I mean, the capital markets were shut down through most of March until the Fed, acted on March 23rd. Then you had the investment grade bond market open up in the last week of March to have the largest issuance, I think, in history, 1 week issuance in history. Then, of course, the high yield market opened up with, Yum Brands and Carnival Cruise. Carnival had to pay like 12% interest. I mean, so yes, that's the irony here. So, if you look at somebody like what Howard Marks has been writing, at Double Line, somebody who does the analysis, does the credit analysis, figures out who the winners and the losers are going to be in this credit crunch, gets it right, but then, if, no offense, no, apologize for the word, gets screwed by the Fed intervening. Now, of course, the Fed has to intervene. Of course, they're the lender of last resort. They have to save the plunging economy. Can you imagine, we have 40 million people unemployed, how much worse it would be if the Fed hadn't intervened, if scores, hundreds of companies that have been able to tap the capital markets weren't able to do that, to refinance debt that was coming due, or bolster their balance sheet by getting more capital, even if they have to pay up. I mean, all of those things are great, but my heart really does go out to people like Howard Marks or Jeffrey Gundlach, who do the analysis and are wizards at the credit analysis, and then the Fed comes in for the second time, in a big financial crisis, and bails out these companies that otherwise should have gone bankrupt or restructured. Rewarding the Howard Markses and the Jeffrey Gundlachs of the world who've done the homework and done the right thing, but don't unfortunately get the fruits of that labor. So obviously it would be much worse. Obviously they have to do this. Obviously the Congress has to act, and you have to give Congress high marks for the size and frankly the speed of the stimulus package. Totally unprecedented. You have to give the Fed high marks for the speed and the size of its rescue package. I mean, for Boeing to be able to raise $25 billion of capital, when it looked like it was going down the tubes, is obviously a minor miracle. And there's stories like that literally every day. I mean, I wrote a piece that just came out in Vanity Fair, and some people are loving me for it, some people are criticizing me for it, where I talk about how Herbalife, the famous Herbalife, just raised $600 million in junk financing, paying a little less than 8% coupon, and they're using that money to buy back shares from its shareholders, the largest of which by far is Carl Icahn. So, here's this company that is helping out Carl Icahn get liquidity for his, Herbalife position that he's owned now for seven years. I mean, I really don't think that that's what the Fed had in mind when it did all this, to help out a billionaire, 18 billionaire Carl Icahn get some liquidity for his Herbalife position.
Sure.
But that's what's happening.
So after the great financial crisis, that was much more in the financial system, whereas this time it's more the general economy, because obviously the COVID is everywhere. So the Dodd-Frank Act tried to make sure that, and the Federal Reserve tried to make sure the banks would be well capitalized so that they wouldn't have to, they would not require a bailout. And that does seem to have happened to some degree. The banks are much better capitalized this time around, and that has not been the real weakness in the financial system. Banks are making loans, they're capable of making loans, and they're doing it. Maybe they're not doing it fast enough, but that's more of a paperwork computer problem than a lack of capital problem. So would you say that maybe a typical problem, like you solve one problem, but then the next crisis creates a whole different problem that you didn't anticipate?
Well, there are always the unintended consequences, right? I mean, I think one of the unintended consequences of QE 1, 2, 3, 4, and now 5, 6, 7, 8, 9, 10, is that risk is being mispriced in the market, and across a variety of asset classes. And again, I think at this point that's to be anticipated, and it's not. It's an intended consequence, because it's obviously they know that this is what happens, and yet we keep doing this. About as far as the big banks are concerned, I mean, I think there are a lot of people now, and I don't know whether you find this in your reporting, Peter, but I mean, a lot of people now are wondering if the banks have enough Tier 1 capital They're of course projecting a great degree of confidence, and nobody's talking about the banks needing more capital, but publicly, the banks are always saying that, banks hate to raise capital, right? They hate that. I mean, that's one of the reasons Bear Stearns and Lehman went down the tubes, because they wouldn't raise capital when they should have. Between, just to look at JP Morgan, they have obviously a huge amount of capital, but they took in the last quarter, $6.5–7 billion loan loss reserves, for anticipated loans that are going to go bad. $6.5–7 billion. They're obviously continuing to pay dividends to their shareholders. So between those two things, you're obviously depleting your capital base, and that's happening. No banks have really said they're not going to pay dividends anymore, and of course, banks have to take their loan loss reserves. So I think there's a legitimate question now, and I had a piece a couple of weeks ago where I talked about the brewing problem in the shadow banking market, which of course was created in the wake of the 2008 financial crisis, because the Fed and other regulators didn't want the Wall Street banks keeping that kind of risk on their books, so they sold it off to these affiliates, basically, of private equity firms that are in the credit business, that have been buying up all these CLOs, and that recently have been doing all these rights offerings. So there's risk now in the shadow banking market, and I think it's a legitimate question to ask now whether the big banks have enough capital, because I think there are a lot of smart people who I've been talking to who think that they don't, and of course the banks won't admit that they don't, and they don't want to raise equity, and they don't want to stop paying dividends. And I think their loan loss reserves are only going to go up. I don't know what you think about that, whether you think.
Well, you kind of made two different points. One is whether the big banks, the commercial banks, are well enough capitalized. And the other is that there's a problem in the shadow banking system. It could be that the big banks, there's separate questions. It could be that both are in trouble, but it could be that they've offloaded some of the responsibilities to the shadow banking, so they're okay, but the problem is migrated to the shadow banking system.
Yeah, well, they've definitely offloaded. They've gotten a big boost from the shadow banking guys with names you've never heard of, like, Golub Capital, or Antares and things like that. People haven't heard of these companies, but a lot of them are affiliated with the big private equity firms. And I'm sure they were making a ton of money before now, and now they've had to do rights offerings to boost their capital. I'm sure the banks would say they have plenty of capital, but I think it's an increasing legitimate question to ask between the loan write-offs and loan reserves that they have to take, the dividends that they're continuing to pay, whether they should be out raising additional capital.
Sure. So would you, just quickly to finish that thought, would you say they should no longer do any buybacks or dividends?
Yeah, well, I'm no fan of buybacks. Look at GE, for instance. They in the last few years of Jeffrey Immelt's being CEO, I think he spent something like $5 that had been raised through the sale of GE Capital and other assets that they sold to buy back GE stock in the 40s. And why did Immelt do that? He did that in part because he thought it was a good investment. He was clearly wrong about that. He also did that because it was a way to get the earnings per share calculation, the denominator, because there are fewer shares outstanding, the denominator goes down, the numerator stays the same, the EPS calculation goes up. So he kept promising people $2 a share, and he wasn't going to get it from earnings. So another way to get it was to reduce the number of shares outstanding. So he did both of those. He did that for those reasons. And now the stock is in the $6. So was that a good investment? Was that a good use of $35 billion? Obviously not. Now, it's obviously easy to see in hindsight, but I just am not a big fan of stock buybacks. Why in the world would investors give Herbalife $600 million so they could buy back the shares of Carl Icahn, who's worth $18 billion. What are people thinking? Just to get a 7.8% yield? So I don't think I'm philosophically and temperamentally against buybacks. Dividends is more complicated, situation. Obviously some industry groups trade on their dividend yield, and to not provide the dividend is going to hurt your share price. But that's an education process. I would say Jeff Bezos is the most incredible educator of shareholders on the planet. He's educated his shareholders that earnings are not that important, and forget about dividends. Jamie Dimon needs to educate his shareholders to do the same thing. GE obviously cut out its dividend, reduced it to like a penny, and its stock is traded for poorly for a long time now. So, look, the most important thing is to preserve capital and use it for good purposes, the smart purposes, the right purposes. And I don't think this is an environment where dividends and stock buybacks are the right environment.
Sure. I'm going to take some questions from the audience. One person referring to the CARES Act, I believe. What about those companies that took funds and did not use them for the intended purpose of paying employees, or who didn't need the funds?
Yeah. Well, we knew that was going to happen, right? I mean, when you put out, I would have, let me just say, former Treasury secretaries, and I'm not name dropping here, calling me saying, like, in the middle of, while the CARES Act was being negotiated and, trying how big should it be, telling me that the Treasury does not have the infrastructure to administer the distribution of these funds. And so what are we going to do? It's even worse than last time, during the financial crisis with the TARP. It was a given that this wasn't going to be administered properly because they just didn't have the manpower. There was a inspector general who was responsible for overseeing all that, who of course Trump, I believe, fired. So it's not surprising that there were problems in this, and I'm sure there's going to be massive fraud and people who got it who shouldn't have gotten it. Some companies who got it, were shamed into giving it back. Some companies who got it that weren't shamed into giving it back, are probably happy to have it. Let's just hope that they kept paying the people who were on their payrolls.
Another question from the audience. Unfortunately, the Fed and the legislative programs only help those with access to capital markets. Nothing for local restaurant, but $182 billion for millionaires with NOL change. Comment.
Yeah, obviously, excellent point, excellent question. Thank you, Gene. The capital markets only serve those companies that can access them, which is big companies, companies with credit ratings, and usually companies with investment grade credit ratings. Now, of course, junk rated companies, high-end junk rated companies, not the CCC variety. And so those that can't access the capital market, that are in the low junk rated category, they're like Neiman Marcus or Hertz, or they're going into bankruptcy, which frankly is what should happen. That's the way the system works best. But forgetting those, that's like a cohort. I don't know what the number is. Maybe 3,000 or 5,000 companies that can access the capital markets. Then there's the cohort of tens and hundreds of thousands of smaller companies that obviously cannot get into the capital markets, never could, never have been able to, who rely on banks. And this is where, of course, and now had to rely on PPP and help from the government. I mean, these companies are really hurting. And hopefully the banking system that we were talking about before is sufficiently robust enough and well capitalized enough that they continue making loans to these companies. And anecdotally, I'm finding that I'm aware of any number of small companies, sort of related to friends of mine, that with a combination of more equity in, the banks are actually being quite cooperative in terms of waiving covenant defaults or other things that can allow them to buy the time they need to get through this. So many companies though are really, really hurting.
Yeah. This is a question that's right up your alley. Please explain shadow banking and how the process works where a bank can sell off its liabilities. Now, you don't really sell off your liabilities, sell off the assets, but anyway, take it.
Yeah. So the short answer is that big banks once upon a time used to be. This is sort of the metaphor. Okay, stay with me here. The big banks used to be in the storage business. They would make a loan, and then they would keep the loan on their balance sheet. And what did they get for that? They got interest payments that they bargained for, and hopefully they got their money back at the end. And if they did the right credit underwriting and priced it properly, hopefully that was profitable and they made money. Nowadays, the big banks are in the moving business. They're not in the storage business. They don't want to keep these loans on their balance sheet. In the years leading up to the 2008 financial crisis, they didn't want to keep mortgage securities on their balance sheet because they like to package them up. Mortgages on their balance sheet, they like to package them up and sell them off as mortgage-backed securities, and they get a fee for that. So it was the greatest thing ever. They would move these assets, these mortgages that obviously had risk to them, off their balance sheet, and they would get a fee for packaging them up into securities and selling them off. And then they could get fees for trading them and working. It was like a great thing. So after the 2008 financial crisis, of course, the Fed which was now the regulator of all the banks, including the investment banks, didn't want them to hold this stuff on their balance sheet anymore and had strict rules about that. So they, were all moved into the moving business. So loans that they made became collateralized loan obligations and sold off as securities. The mortgages continued to be sold off as securities. Other forms of bank debt got packaged up. Auto loans, credit card receivables, all these things got packaged up and sold off as securities. And one of the big buyers, you could say that the beneficiary of this regulatory mandate that the big banks couldn't have these kinds of risky assets on their books anymore was these sort of new fangled non-bank financial institutions that weren't regulated by the Fed, and they would buy these CLOs and CDOs and mortgage-backed securities and this all plethora of all these securities that were being created, and benefit by getting the interest payment and the mortgage and the amortization payments, and created businesses as a result. And as I said, most of them are affiliated with private equity firms, which of course are not regulated either in the same way that the big banks are. And so it was kind of like a symbiotic relationship that they had, which was great for many years until really March of this year, when these securities traded down significantly, and these shadow banking businesses had to raise new equity quickly, and that's why they did the rights offerings. And a lot of people wonder, if in fact some of these, it's an interesting question, if some of these loans that they bought start defaulting, are these shadow banks prepared to act as the representative, in a forceful way as creditors, which may mean going up against the private equity firms that have been there, that they have a symbiotic relationship with? Do they have the guts to go up against a TPG on a failed investment and exercise their rights as creditors of a distressed asset? That is sort of an interesting question that we're still sort of figuring out. They say, oh, we'll work it out. We haven't really come to that. I've seen a lot of press releases, but it hasn't really come to that. We work very closely with these private equity guys, but if we have to, we will exercise our rights as creditors. Well, that'll be an interesting thing for you guys at Bloomberg Businessweek to follow, because it really gets to the heart of these symbiotic relationships that have grown up between private equity firms and these shadow bankers.
Now, that's a fascinating question. Thank you for the story idea. Definitely gonna jump on that one.
Yeah.
One of the questioners, panelists, audience member says, well, given the problems of the shadow banking sector, do you think it should be regulated more by the Fed?
When I wrote recently about that, I got some pushback, saying that I said they were unregulated, or said they were largely unregulated. Of course, they say, oh, we're regulated by the SEC. We have publicly traded equity securities and debt securities, and so we're fully regulated. We're regulated by the SEC. But I mean, the SEC is in a period of light touch regulation. So should they be regulated by the Fed? I don't think the Fed has the capacity to do that, and I don't think these shadow banking businesses clearly don't fall under the Fed's purview. They could, I suppose. Somebody should regulate them more than just the SEC. Somebody should be taking a careful look at whether or not there is real risk brewing. Again, I suppose if you're again, these are companies that most people have never heard of, will never hear of, and they have shareholders. And if they go bankrupt, then I guess the losers are those shareholders. And that's fine with me. That's the way the system is supposed to work.
Well, that's fine, except if it creates systemic problems where suddenly there's a lack of lending capacity in the overall economy.
Yeah, I mean, I think it's designed so that if these shadow banks, fail, that it won't affect the core big banking Wall Street, fully regulated part of the capital system.
Except that if a certain share of all the credit being advanced is being done by them, can the old-fashioned banks pick up the slack immediately? And probably not.
Probably not. It means that those markets that were producing those securities and having these guys as buyers will obviously slow down.
Right.
But that's okay. That may mean that the big banks either have to have be more vigilant in their credit underwriting so that they don't create a bunch of these things that have a ton of risk, or that just slows down. I mean, basically, that's a market that catered to private equity firms doing big LBOs, and if that if private equity firms have to put more equity in, their returns come down. If they can't pay as high, I mean, this whole system enabled private equity firms to pay 11, 12 times EBITDA for these companies, which is of course way, way, way too high a price. But of course, when debt is basically free and they're giving it away, and they're leveraging 7 or 8 times, then you can pay that much. But we need to, that was one of the markets that was getting out of control. So I think another good thing that's happened as a result of this is, when was the last time you heard about a leveraged buyout happening? There haven't been much talk about that. They got a lot of dry powder, right? And they're busy probably shoring up their portfolio companies.
Which is a good thing. A lot of the members of our audience are probably not investing in private equity, but they are investing in the stock market. So got a question here. And the stock market has been really having an amazing resurgence since its lows in March. Are I'm not asking you as an investment advisor, but just as a journalist, author.
Yeah.
Are you nervous about the stock market at these levels?
Yeah, I mean, I was, this is sort of ironic, Peter. I was more worried about the stock market, personally, when it looked like it was, going to have go back to 17,000, 15,000, or as it was falling like a hot knife through butter, and it didn't seem like there was any bottom. That made me more nervous than sort of where it is now. I'm as an investor in the markets myself, I'm certainly glad to see the recovery. I'm glad it hasn't gone to 29.5 on the Dow. Obviously, the S&P is nearing sort of its previous highs. I'm glad that, I'm kind of glad it is where it is. I mean, it's had quite a good run, especially the last until even to the part of today, most of today. The last few days obviously have been unexplainable to some degree. I know that people are wondering how the heck can the market have gone from 18.5 to 25,000, the Dow, when we have 40 million unemployed, and obviously second quarter GDP is going to be rough as our earnings in the second quarter. And I think that, the old adages apply about the stock market. It already, by going from 29,500, again, I'm just talking about the Dow, 29,500 to 18,500. That's, more than a third. That's like a 40% collapse in, what was it, 3 weeks, a month? I mean, that was, and that high yield bond index that I love, going from 5% yield to 11.5% yield. I mean, that was seismic, right? That was huge move in a short period of time. And I think that was the market saying, we're in for a rough time. We're in for huge unemployment. We're in for businesses going out of business. We're in for slowing of GDP, negative GDP. We're in for falling corporate profits. And I think that what has happened is, between the Fed's action and the stimulus and the more stimulus contemplated, yes, 40 million people are out of work, and that is obviously tragic. But a lot of companies have performed better than people thought. There are whole sectors that are actually doing pretty well. And as we, quote unquote, begin to open again, whatever that means, and as we were talking about before, the vaccinators, when and if that kicks in, when and if therapies kick in that actually retard the disease's progression and the virus's progression, and as we learn more and more about how to combat the virus, I think things will begin to be, quote unquote, normalized, but a new normal. So I think the economy will start to do better than people really feared, on March 10th.
Yeah. Well, another point, of course, is that you go back to Amazon, you're talking about how the company has a high stock price, even though not a lot of current earnings. If the investors are trained to think long term, then they might be able to look past a few bad quarters to the long-term earnings potential of companies. So companies that really seem to have a permanently damaged business model, I don't know, making it up here, but cruise ships, you can see why their stock prices might remain down. But any company that still has a viable business model, but has its results depressed by currently bad economic conditions, there's really no reason to have the stock price sell off a whole lot.
Yeah, we need a sort of more of a bridge mentality. But, we've also been trained to, I wrote a column, I guess probably in early March for the Times, about how the first step down, I think investors were saying to themselves, okay, the Dow at 30,000, this is kind of ridiculous. This is, overhyped. Everything, this is priced for perfection. So when the market jerked down the first, time there in the first or second week of March, I thought, and I wrote a column that said this is a perfect opportunity for stockholders to sell, because this is the excuse. There's this fear of missing out, right? You don't want to miss Dow going beyond 30, but with this happening, it was clear that we were on a downward trajectory and that the bubble had burst and that the party was over and we were no longer priced for perfection. So this gave investors the chance that they've been looking for to sell. And I thought that was a great thing. And now personally, my experience is that it's very hard, it's like nearly impossible to time the market. I'm not a fiduciary to anybody. I don't have investors, it's just me and my family. So my experience is that if you, sold in 99, or if you sold after long-term capital management, if you sold after 9/11, if you sold after 2008, if you sold in 2020, then you missed this huge opportunity, right? If you sold, and I understand this, believe me, it takes major cojones not to sell, right? And it's painful, and I'm like questioning myself every day. But if you had sold when the market was at 6,500 in March of 2009, you would have missed the whole move from 6,500 to 30,000.
Sure.
I mean, that's on, how do you defend that? I mean, so stocks are risky. I mean, when you see the Fed, flooding the zone and reinflating the debt bubble, which of course they've now done, then where else are you going to put your money but the stock market, especially when it's been sold off from 29.5 to 18.
Sure. Hey, I just want to remind the audience that we're still taking questions, so please type your question into the question and answer bubble on the screen, and I'll get them in.
Okay.
And
can we put on our crystal ball here and kind of discuss what might be coming down the road? What do you see happening? What would you see learning from this, and what might change, or what you'd like to see changed?
Well, Rhoda, there's a lot I'd like to see changed.
We want to hear it.
Oh, well, so first of all, the most important change that needs to happen is in early November, when people have a chance to vote. And I'm not going to hide my views on this. They're not hidden anyway. So that's the most important change that needs to happen. And I pray to God that is going to happen. On a more sort of parochial level, a more micro level, I mean, I think there's going to be a lot of change for the better. I mean, just in terms of people's day-to-day work environments, how often they have to go, this is nothing revelatory, this is sort of out there, how often they have to go into the office, whether that's even necessary to the extent that we thought it was. I don't think until people feel really safe, they're not going to go back to restaurants. They're not going to go back to movie theaters. They're not going to go back to the theater. They're not going to go back to the symphony. So until, the vaccinators come along, until John Kerry writes his book about the vaccinators, we're not going to, people are just not going to do those things, regardless of whether, the governor of a state says the state's open or you can't. I mean, some people will, obviously, but most people will not. People my age and older are not going to do that. It's just, it's not worth the risk. So that is going to be a big change. I fear for my beloved New York, what that's going to be like after all this is over. Frankly, I lament that while the Fed had to do what it did, in terms of the $6 trillion infusion and getting the capital markets back open again. I mean, as I said, who's benefiting from that? It's we got Herbalife buying back $600 million worth of Carl Icahn's stock. Carl Icahn does not need the help. We've got 40 million people out of work. We've got huge income inequality, and I don't see anything that's been happening addressing any of that. It would be nice. Why doesn't a Jeff Bezos, take 30 billion of his 150 billion? He wouldn't even notice it, and give each of his 600,000 employees $50,000 worth of Amazon stock, and help out 600,000 people just like that. He wouldn't even notice it. And where's those kinds of CEOs taking that kind of leadership in this environment? I mean, that's literally would be the sleeves off the vest of Jeff Bezos. But there's no leadership like that. Nobody's talking about that. So, we're going to have to deal with this income inequality situation. We're obviously massively ballooning the federal deficit, again, under a Republican administration. The national debt is ballooning, again, under a Republican administration. These things have to be reckoned with. We're getting a free ride, of course, because the dollar is the world's denominated currency, and the Treasury can price these securities to get people to buy them, and fund it, spread out the cost of this over a long period of time. But at some point, it's all going to come home to roost. If Trump weren't jawboning Jay Powell into keeping interest rates to zero, this would have a huge effect on the annual budget deficits and in terms of interest expense. But basically, we're able to finance this whole project, this whole $2 trillion project at a very low cost. So, I mean, obviously, fiscally, financially, from a corporate finance point of view, that's the right thing to do. But we're creating huge deficits, huge national debt. The income inequality situation is not being resolved. 40 million people out of work. Hello?
Okay. There's a sort of two streams of thought in what you're saying. That the line about big federal budget deficits is something you usually hear from conservatives, and the line about inequality is something you more hear from liberals. A lot of Democrats, certainly devotees of modern monetary theory, would say deficits really don't matter, that the important thing is to get the economy up to full speed. What do you think about that?
Yeah, I know that's what they say. I mean, I'm not an economist, not Paul Krugman or Larry Summers. I'm, a practitioner, someone who's familiar with the way the capital markets work. We all have to pay back our debts as they become due, or else we're declared bankrupt. Or if we don't pay our mortgage, we lose our home. If we don't pay the debts that we've undertaken, taken out as, running companies, we lose our companies. We have this view that somehow the federal government is immune from this, and state and local governments are somehow immune. You have to pay. We have the economy running white hot, right? As of February 2020. And what do we get for that? Instead of paying down our national debt, instead of trying to close our budget deficits, the projected budget deficit for this year was $1 trillion for one of the first times ever. The national debt was 23 trillion. Where's the Republicans' fiscal responsibility? Completely out the window. So at a time when the markets and the economy was running white hot, according to our president, do we show any fiscal responsibility? No, not a whit. Now that's all completely gone out the window for good reasons, obviously. and nobody's even talking about that anymore. I mean, I just think, we've got Donald Trump criticizing Bernie Sanders for being a socialist. I mean, who's the bigger socialist here? Donald Trump is the president, the CEO of the country at a time when the Fed is underwriting the capital markets, when the budget deficits are growing huge and the national debt is obscene. So free market, this idea of free market capitalism is clearly out the window. And I just find it incredibly ironic that it's happening again under Republican administration.
Yeah. I got another question from the audience talking about, is there any way to direct money to things the country needs, such as bridges, roads, airports, internet access to underserved areas?
Well, of course there is, but it's not for Peter Coy and Bill Cohan to do. I mean, if Congress would agree on those projects, which are so obvious to do, it's just mind-boggling that we don't do it, but yet we never do it. It's a clear, huge opportunity. Not only is it sort of like a WPA project, put people back to work, but interest rates are near zero, so why not borrow more money and do it? We obviously need a high-speed rail system in this country. We need to fix Amtrak. We need to fix the post office. We need to fix bridges and tunnels. I mean, it's extraordinary that we haven't done this. I don't know why we don't do this. I don't know what's wrong with our leaders that they don't do this. That's a great question. There should be, this is a perfect time to build the new tunnel between New Jersey and Manhattan. I mean, let's do these things.
Sure. Hey, I just want to ask Rhoda how much time we have.
And so we can continue.
Okay, you were muted for the beginning.
I'm willing to, we can go till 9 o'clock if we are, or sooner, depends on how many questions we have.
Okay, because I'm going to reiterate that we're open to questions. If I don't get too many more questions soon, I'm going to start to wrap it up with Bill. But just for now, Bill, you worked in Wall Street and you still have a lot of contacts there. What are you hearing from your people that you stayed in touch with all these years about COVID-19? Are they, as we hear this expression, armchair epidemiologists? We've all become armchair epidemiologists, learning about R0 and force of infection and so on. Do you see the people that you deal with trying to get up to speed on this virus? Are they taken aback by it, or how do they perceive it?
Well, I mean, I think everybody I know who's either worked on Wall Street or still working on Wall Street, they're all at home, right? They're, quote, not on the front lines. They don't have to be on the front lines. They have and can afford high-speed internet connections. They have and can afford, best computers. They can stay networked. They can run their businesses or do their jobs from home. So on the one hand, they're sort of dealing with, the WFH situation, and most of them seem fine about it. I wrote a piece, I think last week in Vanity Fair about what Wall Street was thinking about the opening up. Is now the cure worse than the disease? Is it gone on long enough? Do we have to get this show on the road? Can we got to open up this economy? And I would say that everybody I talked to said absolutely enough is enough. We have to have smart openings of the economy. We can't keep doing this. If they were real epidemiologists, like they said that people like Fauci, God bless him, he gets paid whether or not the economy is open or shut, right? and he's going to err on the side of safety, as that's his job. But you know, there has to be smart openings. People who are at risk, people of a certain age, obviously cannot be, shouldn't be. I mean, it's their choice, but they shouldn't be, you know, going back to the office. They shouldn't be going out to restaurants or theaters or any of those, you know, places where there are a lot of people. But for younger people, who is like most of the people in the workforce, I think there was this view that, you know, I wrote about last week, that, you know, it's time to get people back to work, because we can't, you know, have 40 million people out of work. You know, this is, you know, I'm just a vessel here expressing this point of view. We can't have 40 million people out of work, you know, because 100,000 people died. That is a very prevalent feeling on Wall Street right now.
Got it. And how about the Wall Street firm's own operations? Do you think people are surprised at how well they've been able to get the job done while working from home?
I think they're pleased and surprised.
Yeah.
I think they're glad. I'm not, you know, I think they feared something much worse.
Yeah.
Yeah, but you know, when 97% of the people at Goldman Sachs are working outside the office, and they're still able to do their thing, especially trading and underwriting, I think they're, you know, very pleased about that. Obviously, the M&A market has been much tougher in this environment, as you might expect. But you know, I've talked to plenty of M&A guys who've been doing big deals over the phone.
Sure, amazing.
And you know, it's incredible. You know, think about it. If you are, now I was an M&A banker for 17 years. If your relationship with your client is sufficiently firm, that you don't have to get on a plane and go out and see him or her, and you can do it on the phone because they trust you, they know you, they like you, they want to work with you, they want you to help them solve their problem at this particular moment. I mean, that is, you know, for an investment banker, you know, that's like nirvana, that you don't have to get on a plane and fly overnight to Madrid or wherever it is. You know, you can stay in your time zone, you can be much more productive, you can get things done, you can get deals done. You know, the lawyers can execute the documents all from home and remotely, and that is, you know, that is a bonanza if you're a banker who, like, you know, I always had to, you know, get on a plane and go see a client, which was fine. I, you know, enjoyed seeing clients, but you know, if somehow I could get to the point where the client trusted me enough and wanted me to be on their side at a crucial moment like this, and I didn't have to travel to get there without all that brain damage that occurs from traveling, I mean, that's great. So that, I think, has been a revelatory to a lot of bankers. And, you know, I wonder, you know, I think that people talk a good game about how things are going to change in the middle of a crisis. But once the crisis passed, once the vaccinators come, once we're vaccinated, once we don't fear going out anymore, once we feel safe, you know, all these pledges and promises of a new way of doing things, in my estimation, tend to go out the window.
Sure, yeah. Two last things. What is the biggest investment worry? This is a question from the audience. The biggest investment worry if unemployment stays high throughout the year?
Well, I mean, any business that obviously relies on having its employees actually physically in place and can't work remotely. So that means more restaurants go down the tubes.
Yeah.
You know,
sure.
Lines will struggle, cruise lines will struggle, amusement parks, you know. I mean, you know, I was, you know, just talking to a hedge fund manager today who's, you know, invested in Disney, and he sees the other side of it. He sees Disney Plus. You know, despite the parks being closed, despite the cruise line being closed, despite Disney's theaters and production being closed, you know, he sees Disney Plus as, you know, a way out, you know, providing, and obviously it is. I mean, people are gobbling up this content at home every night.
Yep, good for them. I'm going to wrap it because it's getting a little late. I'm not going to be able to ask every question that came in, but
Peter, I really think that the last question was a good one.
Okay, I'll ask it then.
Yeah.
It seems to me, this is a question, oh, I see, this is from Gene Cornell, I didn't notice. It seems to me that we are failing the Main Street economy, failing the public health challenge, and are likely to see a depression. Case in point, Korea has 300 deaths. They do contact tracing and they have places for infected people to stay isolated from their families. We have none of that, not even enough tests. How do we go forward? No smart opening is possible here. We are a failed state. Thoughts?
It is an incredible failure of leadership, an embarrassing failure of leadership. It's a frightening failure of leadership. It's incredible to me that we don't have testing, that we don't have tracing. It's incredible to me. I mean, I thought this was the greatest country on earth, the wealthiest country on earth. It's an unbelievable failure of leadership. Yeah. But guess what? It is what it is. As I said, when Rhoda wanted me to prognosticate, the most important thing anybody can do is vote in November and end this madness, okay? So once the madness is ended, I mean, we can begin to repair and rebuild and to turn the battleship around. In the meantime, there is some leadership at the state level, and we're just going to have to, on the one hand, we're a very entrepreneurial nation. We're used to taking things in our into our own hands, and we're just going to have to do it. We're family by family, we're just going to have to take care of ourselves because there's no safety net that the South Koreans managed to provide to their citizens, but our leadership failed to provide that to us. And the only chance we have to rectify that is in November. I suggest we take it. And until then, we're going to have to be pioneers. We're a very pioneering country. We have a pioneering spirit. We're going to have to take matters into our own hands and do what's best for us and our families. And hopefully that collective behavior will lead to collective wisdom, which I'm sure it will, while we, bear with the next, whatever it is, 6 months that we got to bear with this thing.
Last question, political. Speaking of the election, from Stanley Goodman, is Mr. Cohan ready to run for president?
Well, I'm younger than Trump did when he ran for president. If I had his bank account, it might be worth a try.
All right.
So if Mike Bloomberg will bankroll me, you might ask him that when you go back to work.
I'll put you in touch.
Put me in touch, then.
All right.
If that's the will of the people.
The will of the people. Okay. Well, thank you very much to Bill Cohan and Rhoda. I'm turning it back over to you.
Yeah, thank you.
Thank you, Peter. That was fabulous.
Thanks.
Okay, I want to thank you guys. It was really a wonderful evening with you, and I think we ended on the right note. Everybody get out and vote, and let's try to make things better and change things. So thank you so much. And if some of you still have questions, you can send them to info@nfrpp.org, and I'll bother Bill and Peter to answer them. Okay? So thank you again. It was wonderful. And good night, everybody.
Good night.
Good night. Thank you.